It wasn't a speculative frenzy. It wasn't a temporary supply chain glitch. It wasn't even a simple case of market manipulation. It was the inevitable collision between finite geology and infinite liquidity. The pattern is unmistakable. History does not whisper. It shouts, and right now the arithmetic is merciless. To understand the true potential of silver, you must look past the daily volatility. You must look past the noise of the futures market. You must look at the structural decay of currency systems over millennia, because the current price of silver is not just a market inefficiency. It is a monetary illusion. We are witnessing a divergence between the paper price of assets and their physical reality. This has happened before. The timeline is long, but the signals are consistent. When an empire overextends, it devalues its currency. When the currency devalues, the crowd chases paper yields, but the smart money moves quietly into the physical, into land, into gold, and historically into the most industrial of all monetary metals, silver. The opportunity today is born from a rare dual mandate. Silver is money, but silver is also technology. The pattern of undervalued hard assets exploding upward during monetary transitions is verified by history. We can prove this pattern by examining 3 specific case studies. 3 empires, 3 currencies, 3 identical outcomes. The Roman Empire, the British Empire, the Weimar Republic. The sequence is always the same: peak dominance, unsustainable costs, the monetary shortcut, and finally the flight to safety. In the 1st century AD, the Roman Empire sat at the apex of its power, but the costs of maintaining its legions and bureaucracy were bleeding the treasury dry. The pivotal moment came under Emperor Nero around 64 AD. Faced with the massive costs of rebuilding Rome after the Great Fire, Nero chose the path of least resistance. He did not cut spending. He did not raise taxes, which would have sparked rebellion. Instead, he tampered with the silver denarius. The incentive was political survival. By reducing the silver purity of the coin from 100% to roughly 90%, the state could mint more coins with the same amount of metal. It seemed like free money, but this was only the beginning. Over the next centuries, subsequent emperors repeated the trick, driving the silver content down to 50%, then 5%, until the denarius was little more than copper, washed in a thin silver coat. Consider the Roman legionnaire. He signed up for 20 years of service, promised a pension in silver. By the time he retired in the 3rd century, his pension was paid in debased coinage that could barely purchase a loaf of bread. The silver had vanished from circulation. Hoarded by those who understood Gresham's law, bad money drives out good. The physical metal retained its purchasing power while the state-issued currency evaporated. Just like Rome, the British Empire faced a similar crisis of solvency, though it played out through paper and ledger entries rather than coin clipping. From 1914 to the 1970s, the British pound sterling underwent a slow, agonizing death as the world's reserve currency. Anchor date here is 1914, the outbreak of World War I. To finance the war, Britain suspended the gold standard, effectively unmooring the currency from reality. The costs of 2 world wars and the establishment of a welfare state created a debt load that could not be paid back in honest money. The incentive was to inflate the debt away. By 1967, the pressure was undeniable, forcing Prime Minister Harold Wilson to devalue the pound against the dollar and gold. He famously assured the public that the pound in your pocket had not lost its value, but the arithmetic disagreed. A clerk working in London saw his savings stagnate while the cost of hard assets began to climb. Those who held paper sterling lost roughly 99% of their purchasing power. Against gold and silver over the course of the century, the empire retreated, and the currency collapsed in value, leaving the middle class to absorb the loss, just like Britain. The Weimar Republic in Germany offers the most terrifying example of how quickly this dynamic can accelerate. The year was 1923, saddled with impossible war reparations and a crippled industrial base. The German government turned to the printing press with reckless abandon. The velocity of money exploded. But here is the key detail often missed in history books. While the paper mark became worthless, the value of silver did not change. Its price in paper merely adjusted to infinity. There are accounts of middle-class families selling a single set of silver family heirlooms to purchase an entire city block of real estate. A factory worker paid in paper billion-mark notes had to rush to buy anything tangible before noon, because by evening, the currency would be halved again. Those who held silver maintained their wealth. Those who held paper were wiped out. The transfer of wealth was absolute. The pattern repeats in 7 distinct stages. Stage 1 is sound money, where the currency is backed by tangible assets and trust is high. Stage 2 is overextension, where the state takes on obligations it cannot fund through taxation. Stage 3 is the turn, the moment the government chooses inflation over austerity. Stage 4 is inflation, usually dismissed as transitory or necessary for growth. Stage 5 is denial, where the state blames speculators, hoarders, or foreign actors for rising prices. Stage 6 is the flight to real assets, where the public loses faith and dumps currency for land, gold, commodities, and silver. Stage 7 is collapse and reset, where the old currency is abandoned. Just like the flight to assets in Weimar Germany, current data suggest we are entering Stage 6. The warning signs are flashing across the global dashboard. Sovereign debt levels across the G7 nations have reached mathematical points of no return. But silver occupies a unique position in this cycle that distinguishes it from gold. While gold is pure money, silver is a hybrid. It is an industrial necessity. We are seeing a collision between monetary demand and industrial consumption that has no historical precedent. The green energy transition, solar panels, electric vehicles, 5G infrastructure requires massive amounts of physical silver. Estimates range, but the solar industry alone consumes a significant percentage of annual mining supply. Here is the constraint. Silver mining is largely inelastic. Most silver is mined as a byproduct of lead, zinc, and copper. You cannot simply flip a switch to produce more silver just because the price rises. Mines take 10 years to come online. We are facing a structural deficit where consumption outstrips supply. Exactly at the moment when investors are beginning to question the validity of fiat currency, the incentive for the industrial user is to stockpile before prices rise. The incentive for the investor is to flee debasing currencies. These two forces are competing for a shrinking pool of physical metal. Some economic historians argue that silver is no longer a monetary metal, having been demonetized in the late 19th century, and therefore will not behave like gold in a crisis. They suggest it is merely a volatile commodity. However, this ignores the monetary history of the last 5,000 years. Central banks may not hold silver, but the people do. When confidence in sovereign debt wavers, the memory of silver as money returns instantly. Furthermore, the industrial floor puts a hard limit on how low the price can go, while the monetary premium offers uncapped upside. Under these constraints, the rational move for capital is to seek assets with finite supply and essential utility. The endgame arrives in one of 3 ways. First, a controlled decline. This is the preferred path of central planners. We saw this with the Bretton Woods Agreement in 1944, where currencies were repegged and devalued in an orderly fashion to wipe out debt burdens. Over decades, inflation runs hot, but not hyper. Silver performs exceptionally well here, outpacing the rate of inflation as a leverage play on hard money. Second, a chaotic collapse. This is the Weimar or Roman scenario. Confidence evaporates overnight, supply chains break. In this scenario, silver becomes a survival tool, a medium of exchange when digital systems fail or paper is rejected. The purchasing power of an ounce of silver disconnects entirely from its production cost. Third, a reset and restructure. This involves the introduction of a new system, possibly as central bank digital currency or a commodity-backed note, to restore confidence. Historically, resets often involve a revaluation of precious metals to backstop the new liabilities. We saw this when Franklin Roosevelt revalued gold in the 1930s. in a reset scenario. Strategic commodities are often repriced to reflect the new volume of money in the system. The trajectory is set by the debt. The arithmetic cannot be bargained with. The only variable is timing and pain. Subscribe to the channel to track these macro signals as they develop. True preparation is not just about buying assets, it is about education, resilience, and understanding the difference between price and value. Stay skeptical, stay prepared.